Hello students, this is Professor Watts, and today we are going to talk about some international monetary institutions. So we'll start with a little bit of international monetary system history and evolution. We'll talk about the rationale for currency unions. We'll look at currency crises, what triggers them and what their results are. And then finally we'll conclude by discussing the costs and benefits of fixed versus flexible exchange rates. And this will give us some background and context for a deeper understanding of what's going to be a central focus of this class, which is going to be thinking about multinational corporations dealing with exchange rate risk. So we want to understand how international currency exchange works, and in order to do that we want a little bit of background on the international monetary system. So history-wise, we're only looking at the modern era, probably from about the mid-1800s to the present. And what was common really after the emergence of the United States and the international scene, so as of the late 1700s, early 1800s, was a monetary regime called bimetallism, two metals, and those would be gold and silver. So you could bring either gold or silver to the mint in your country, and this was in place in many countries, including for a time the United States, and convert those into monetary units at a specified weight and value for your currency. So the US dollar was defined legally as 371 grains of silver and 24.75 grains of gold. Now there's a problem with bimetallism, and it's known as Gresham's law. Here's what the book says. Gresham's law dictates that under the bimetallic standard, the abundant metal was used as money while the scarce metal was driven out of circulation, because the ratio of the two metals was officially fixed. Now, let me give you a little bit more background on that. One of my favorite economists, Ludwig von Mises, and he has a much better, I think, and more precise definition. So here's what Ludwig von Mises says. Bad money, says Gresham's law, drives good money out of the country. It would be more correct to say that the money which the government's decree has undervalued disappears from the market, and the money which the decree has overvalued remains. So let me give you an example to think about how Gresham's law works and why, when you have a gold and silver side-by-side standard, one of those metals is going to win out and dominate commerce and international exchange. And this is a little ridiculous, but I think it'll help you illustrate what's going on here. So let's say the state of Michigan decrees that thumbtacks must be accepted at a value of $1 each in exchange for all goods. Okay? So we're going to a thumbtack standard, and we've pegged the value of the thumbtack to $1. Well, what do you think is going to happen? It's not going to take much imagination to realize that everybody's going to use thumbtacks only in exchange because they're now worth $1. What's going to happen with dollars? Well, you're probably going to take all the dollars you have and use them to buy thumbtacks. So dollars are going to essentially be exported to buy thumbtacks, and thumbtacks are going to be used for all transactions. I'll show you the math on this. So I actually did some looking on Amazon, and I found that you could get 600 push pins or thumbtacks for $7.49. So that would be what we call a market exchange rate of $0.012 per tack, 1.2 cents per tack. Okay, the mint exchange rate, in other words, the decreed value from the government, is $1 per tack, and that works out to 80 tacks per dollar. So the mint price of tax is much higher than the market price of tax. The mint's giving you a better deal for tax, so you're going to take tax to the mint, so to speak. Now, if it were gold or silver, you'd have to take it to the mint to be turned into coins. In my example, you just take your tax straight to the market and buy things with them. The mint, the government, has overvalued tax relative to the dollar, and by the same token has undervalued dollars relative to tax. So tax only will circulate in transactions. The dollars are going to be shipped out to purchase tax. Okay? So this is exactly what happens. Imagine now, instead of dealing with tax and dollars, we're dealing with gold and silver. There was a prevailing market exchange rate, and what happens is that market exchange rate changes because miners are going to find either more gold or more silver, and the market price ratio between gold and silver is bound to change over time. There's not a fixed relationship between the values of gold and silver in the world. So I'll give you a very simple example as applied to bimetallism. Say the mint ratio is 2 to 1. And that's silver to gold. So that means 2 ounces of silver has the same monetary value as 1 ounce of gold. The mint will exchange 2 units of silver for 1 unit of gold, or vice versa. Now, as I said, will happen eventually, because miners will either find a new silver discovery or a new gold discovery. Sometimes they find both together, but the one or the other metal is going to be relatively more abundant. So let's say there's a big silver strike and the silver becomes a little bit more abundant, and that's going to cause the market ratio to rise to 3 to 1. In other words, now you need 3 units of silver to buy a unit of gold. So a profit maximizing strategy emerges if the government doesn't update the mint ratio also to 3 to 1. Now they eventually probably will, but in the meantime entrepreneurs are going to catch on to this strategy. You take 2 units of silver to the mint, in exchange you get 1 unit of gold. You take that gold back to the market and you get 3 units of silver. You take that back to the mint, and at the old mint ratio of 2 units of silver giving you 1 unit of gold, well, now you've got 1.5 units of gold. So you just increase your gold 50%, and you just rinse and repeat until you become very rich very quickly. Okay, so here's what's going on. Now, the result is that gold is undervalued by the mint. The mint is saying gold is worth 2 silvers, where the market's saying gold is worth 3 silvers. And that means, again, silver is overvalued. The market says a silver is worth 1/3 of a gold, where the mint says a silver is worth 1/2 of a gold. Silver alone will be sent to the mint and coined. Gold will all be exported or sold into the metal market to obtain more silver at the higher market price. Okay, so what's going to happen is legally overvalued silver has chased undervalued gold out of the market. And then the government eventually, like I said, will have to catch up, adjust the mint ratio to match the market ratio, or you're going to be on a de facto silver standard. Now the government will raise the mint ratio and try to reestablish the coinage of both metals, and maybe that'll work for a time, but then the mint ratio either goes up again or it goes down, and then either silver or gold is going to again prevail. And that is exactly what happened. If you study monetary history at all, which I have in particular for the United States, bimetallism was never stable. We went to silver, and then we went to gold, and then eventually the government gave up and said, okay, we're only going to be on a gold standard alone. So as of 1879, the U.S. was a gold standard alone. And that brings us to the classical gold standard. So from about 1875 till the outbreak of World War I in 1914, the entire Western world was on what's called the classical gold standard. Full-fledged gold standard. The currencies of all the major international powers were defined in terms of their gold content. Okay, so that lasted, as I noted, until World War I began, and countries uniformly abandoned the gold standard because they wanted to inflate their currencies. They wanted to print money to help finance their war efforts, and of course you can't maintain a currency's convertibility into gold if you're printing excess money. But note this, and this is what we're interested in. Under the gold standard, the exchange rate between any two currencies is determined by their gold content, and it's fixed, it's locked in. Here's an example. Suppose the British pound is pegged to gold at 6 pounds per ounce, whereas 1 ounce of gold is worth 12 French francs. So we want to say this: an ounce of gold is worth 6 pounds. The same ounce of gold, if you took it to the mint in France, would be worth 12 francs. So we can work out the exchange ratio between pounds and francs. 6 pounds has to equal 12 francs because they're both defined as 1 ounce of gold. So that means 1 pound is worth 2 francs. Or we could also say a franc is worth 1/2 of a pound. Okay, so that exchange rate between the pound and the franc is going to be locked in there at 2 francs per pound. And if it changes for some weird reason, like if the pound suddenly becomes worth more than 2 francs in the market, well, people holding pounds are going to buy more francs and then take their francs, turn them into gold, and take that gold and go buy more pounds, take the pounds, go buy francs. And what that's going to do is drive the demand for francs up relative to pounds, which will drive their price back up in terms of pounds until you get back to the 1 pound to 2 francs exchange rate. So the classical gold standard is a very fixed and rigid and stable international monetary regime. Now, we want to talk about a major aspect of the international monetary order under the classical gold standard. And this is how countries are going to adjust what's called the balance of payments surplus or deficit. So we'll talk more about balance of payment situations in the chapter 3, which we'll cover next week. But for now, it's just we'll just summarize that as whether a country is importing more than it exports or exporting more than it imports. And if it's exporting more than it imports, it'll have a balance of payments surplus. In other words, it'll be collecting money on the net. If it imports more than it exports, the country has what's known as a balance of payments deficit, and it'll either have to export money or some other financial claim in order to even out its accounts. Like I said, we'll cover that in detail later on. But let's talk about how this worked under the classical gold standard. And it was a phenomenon called the price specie flow mechanism. It's an automatic system that corrects imbalanced balance of payment situations between two countries operating under the gold standard. And it relies on the fact that gold will flow in or out of a country depending on what changes in what's called the terms of trade. So let's look at an example of the classical gold standard adjustment mechanism, the price specie flow mechanism at work. And this is from a historical episode that I've done a little bit of research into. This is the United States and mostly Great Britain, but just international trade occurring in the 1790s. This is kind of a simplified example. I've simplified the math here, but this represents in essence what happened in this particular episode. So we have an initial situation where, because both countries are on a gold standard, you have a fixed exchange rate, and it works out roughly to £1, one British pound equals $5, $5 US. They're technically both on silver standards here, I should note, but gold and silver, as I mentioned, both circulated in the US in a bimetallic system. Okay, and then the US price level, in other words, the price of domestic goods in the United States, is initially set at 10. And that's just an index value, so we can set that anywhere we want initially. The important thing is to note that the change in the price level represents either inflation or deflation occurring in the domestic economy. Now, what happened in the US in the 1790s was that with the advent of the first Bank of the United States, we had a major credit expansion episode, which led to a lot of new business formation and investment, corporate investment, and an increased spending. And that, of course, is going to lead to inflation usually, and that's what happened in the US. Now, inflation was actually probably a little bit more severe than this, but I want to keep the math pretty simple. So I'm going to say the price level in the US goes from 10 to 12, and this is over the course of about 3 or 4 years, so it's pretty steep increase in inflation in a short period of time. In fact, we have a precisely 20% increase from 10 to 12 in the price level. Again, I'm kind of massaging the numbers here to make the math easier, but this is roughly representative of the reality. Okay, now we might think, well, because we had a 20% increase in US prices, that means the dollar's worth less, right? So what should happen to the dollar-pound exchange rate? If the dollar is worth less, goods in the US cost 20% more, that means the dollar should fall approximately 20% in foreign exchange. So we might think that, well, the dollar falls so that instead of $5 buying a pound, now it takes $6 to buy a pound. And if the dollar's falling, right, the pound is rising. So you can see that the pound used to be worth $5 and now it's worth $6. That would be an increase in the pound. The dollar, if we wanted to do the dollar exchange rate, we could say $1 over here used to be equal to 0.2 pounds, 0.2, and now $1 is equal to 0.16 pounds. Right? So that would be the roughly the adjustment needed in the exchange rate to represent the fact that the U.S. price level has gone up, the value of the dollar has gone down. But remember, we are on a fixed exchange rate under the classical gold standard or specie standard, right? Gold/silver. And so that can't happen. So what's going to happen instead is that we're going to have a specie drain. Gold is going to flow out of the U.S., and what's going to happen as gold flows out of the U.S. is that the U.S. domestic money supply is going to go down, and as the U.S. domestic money supply goes down, prices eventually fall, and they roughly get back to their old price level of 10, and that will maintain the parity of 1 pound to $5. One of the reasons gold is going to flow out of the U.S. is because as domestic prices in the U.S. rise by 20%, foreigners, like people in Britain, say, we don't want to import goods from the U.S. anymore, or not as many, because they're more expensive than they used to be. So we'll import goods from France or Germany or Russia or whatever. And so the U.S. is not going to export as much goods. Meanwhile, because there's an increase in the money supply in the U.S. is going to try to import even more goods from Britain, because we have more money floating around and we're more willing to spend it on imports. Well, to pay for that increase in imports, so let me draw this here. We have a big increase in imports from places like Britain and France. They're not going to be paid for as much by exports as they used to be, because as I just mentioned, exports are going to be down given that U.S. products are more expensive with this inflation. So instead of doing exports to finance all of our imports, we'll still have some exports, but now we're also just going to send gold or silver, we call that specie, to Britain to help pay for the imports that we can't pay for with exports. And that's going to occur. That specie is going to flow out of the U.S. until the U.S. price level comes back down and the fixed pound-dollar exchange rate makes sense. So that is what would happen and what did happen, and this is just one of many historical instances of this occurring under the classical gold standard. Now, you might be wondering, this is ancient history, Dr. Watts. This happened in the late 1700s. Why is this relevant for us now? Well, I think having a little bit of this historical knowledge under our belt is going to help us understand phenomena that are still relevant, even though gold has not played a part in the international monetary regime for almost 50 years. The idea of balance of payments, surplus and deficit, and needing to finance those or needing to take care of those in one way or another is still relevant. So if we understand how it occurred in the past, that'll give us some context for understanding how it's playing out today. So I think this will be relevant for us, so bear with me. Okay, so between World War I and World War II, we went off the gold standard in most of the Western countries. As I said, the countries wanted to print a lot of money to finance the war effort. They couldn't maintain gold convertibility. They did what's called sterilizing gold flows. So they tried to make gold irrelevant for their monetary policy. And countries tried to depreciate their currencies in order to make their own exports more attractive to foreigners. Very bad situation for international trade. We had the Great Depression, not necessarily caused by deteriorations in international trade, but definitely exacerbated by it. Economic nationalism. Countries tried to encourage exports and discourage imports. They slapped a lot of high tariffs on each other. Economic and political instabilities due to the high unemployment associated with the Great Depression, financial crises, and flights of capital across borders, especially as the Nazis came to power in Germany, and that got people worried about another war breaking out, and that caused a lot of businesses and private individuals to send money to safe havens, and at that time that was largely the United States. So there was a lot of monetary chaos during this period, and then when World War II broke out and finally the United States joins the Allies, the Allied powers, they realized, at some point that they're going to win the war because of their industrial superiority. So Allied powers got together and developed a blueprint for the international monetary order in the post-World War II year, the Bretton Woods system. Bretton Woods is the hotel and resort in New Hampshire where these representatives met, including famous economists such as John Maynard Keynes from Great Britain, Dexter White from the United States. And what they wanted to do was establish something that would have the stability and automaticity that the classical gold standard had, but without the difficulties associated with the classical gold standard. So what they came up with was called the dollar-based gold exchange standard. Talk more later on about why this system didn't really last that long. It didn't even make it 30 years before it collapsed in the early 1970s. But let me just show you how this works. So in this system, the US dollar is going to be the only currency defined in terms of gold. It's pegged at $35 an ounce. That was a pretty significant devaluation of the dollar against gold, against what had prevailed before. The historic gold standard in the U.S. had the dollar or price of gold at about $20 an ounce, a little bit under $20 an ounce. So this is a big devaluation of the dollar. Well, that was necessary because the United States, like most countries, had printed a lot of money to finance its war effort, and printing money leads to a decline in the value of money, as I hope you remember from your macroeconomics classes. Okay, so the dollar was pegged to gold, and then every other currency was just pegged to dollars. So we had a pegged or fixed exchange rate between all these other currencies and the US dollar. And then foreign countries could use US dollars as their reserves rather than gold. So this kind of allowed us to economize on the world's stock of monetary gold. Only the US needed to hold gold. Every other country could hold dollars, and the US could export dollars to finance balance of payments deficits, which is what the US did. Maybe did too much of that, and other countries started to worry that the US has printed too many dollars. They can't sustain gold convertibility at $35 an ounce. And foreign countries, France in particular, during the mid to late 1960s, they started to realize there's no way the US can maintain gold convertibility of the dollar. They started wanting to turn in the dollars they were holding and receive gold, and that caused a gold drain for the United States in the late 1960s. And eventually the United States realized that we can't sustain this anymore, so we have to abandon the gold exchange standard. And that occurred in 1971. It was called closing the gold window. That was done under the presidency of Richard Nixon. Okay, so that brought us to what's known as the flexible exchange rate regime. Now the book says 1973 to present. That's because the Bretton Woods system was there was attempts to kind of extend it and tweak the gold value of the dollar. It was doomed to failure. Everybody knew it, so it really just was kind of a desperate attempt to maintain the Bretton Woods system. Didn't last long at all. So the Jamaica Agreement finally brought us to the system that roughly we have today, which is flexible exchange rates or floating exchange rates between the major powers of the world. So currencies are no longer tied to each other. Under the classical gold standard back in the 1800s, early 1900s, and then under the Bretton Woods system from 1945 to the early 1970s, we had fixed exchange rates or quasi-fixed exchange rates between currencies. Well, when that broke down in the 1970s, now we're on purely flexible or purely floating exchange rates. So the value of every currency in terms of any other currency is determined purely by market forces, changes in supply and demand. IMF, the International Monetary Fund, was part of the Bretton Woods system. It was an institution that member states contributed money to, and then it would help countries that were seeing balance of payments problems. So it would help them finance their balance of payments deficits. Along with that was established the World Bank. Gold is demonetized. A lot of countries started selling off their gold. It's no longer legal monetary asset, legal tender. So countries no longer need to have gold stocks as reserves. You can see that after Bretton Woods ends, right about in here, early 1970s, the dollar starts to fluctuate against other currencies. I'll just summarize all this by saying that under flexible exchange rates or floating exchange rates, which again we've had since here, exchange values of major currencies can be engineered by monetary policy, by treasury policy or fiscal policy, and by agreements between countries. But they're not stable, and they constantly have to be readjusted and retweaked. So foreign exchange management is now a pretty big part of government policy and economic policy. And it's of relevance to us because if you're in the multinational corporation scene, you want to be able to understand whether the value of your own currency is heading up or down, whether the value of currencies of the major trading partners is going up or down. So it is pretty relevant to understand these things.